Please stand by. Good day, everyone, and welcome to the Softrax Executive Webcast. As a reminder, today's call is being recorded for future playback. At this time, I'll turn the conference over to Mr. Bob O'Connor, President and CEO of Softrax Corporation. Please go ahead, sir.
Thank you, Jim. Softrax is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today. And we do have several hundred registrants for today's webcast, which indicates how much executives want to hear about today's topic from our two distinguished speakers from Grant Thornton. They are Mike Schamberger and Jim Ravell. Both will participate in the presentation entitled Preparing for Your Audit, an Insider's Guide, and both Mike and Jim will be available for questions at the end of their presentations. Our audience consists of CEOs, CFOs, board members, venture capitalists, VPs, accountants, and other corporate and financial professionals. And let me just take you quickly through our agenda. I'll spend a few minutes on revenue management and Softrax and how that fits in today's topic of the auditor. And then I'll turn it over to Mike and Jim, who will spend most of our hour together on their presentations. For those of you who are familiar and even those who are unfamiliar with our format, we leave the last 10 or 15 minutes of the hour open to your questions, and Mike and Jim will be available for those. All of this will be done by the top of the hour. And the way to submit questions, and again, it's a very important part of our webcast. The way to do that is look on your console, and you'll see an Ask a Question box. And if you click on that and ask a question, I will be reading those throughout the webcast, and then I'll ask Mike and Jim at the end of the presentation. The most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for those. Upon the conclusion of the webcast, your browser will be automatically redirected to an online survey page. We'd like you to fill that out. It doesn't take long. Please complete it. We listen to that, and it guides our future webcasts. After you do that, the presentation slides will be directly downloadable, and you'll also get the 13th edition of the Survey of U.S. Business Leaders that Grant Thornton publishes as an additional gift for participating, as well as offering some feedback. Interestingly enough, Jim and Mike, I was on an airplane yesterday reading it, and I was putting it back in my briefcase, and the person next to me said, "Are you done with that? I'd like to read it." So people are looking for these at all altitudes. So let me get going and just give you a few minutes on Softrax revenue management and how we fit into this overall picture. As a matter of introduction, we do provide revenue management software to many different industries. As this next slide will indicate, throughout the U.S. and the world, hundreds of companies in several different industries use our software products to manage their revenue, their billing, revenue recognition, revenue reporting, and forecasting. And as you may know, Softrax started by serving one of the most difficult industries, the software industry, as it relates to revenue recognition and the like, and we are the clear leader in that market. And as you can see on the slide, which is a little bit of an eye chart, we have grown to address the complex revenue needs of many different industries. In a recent study by RevenueRecognition.com and IDC, it was found that existing financial applications and systems of both public and private companies are not managing revenue accurately in revenue recognition process, and that public companies and private companies, but mostly public companies, in terms of importance, are still relying on a lot of manual processes to manage their revenue. And in a previous study, the risks of continuing the use of a lot of manual processes and spreadsheets in terms of revenue recognition were identified here by the participants in the study, including errors and the lack of audit trail and lack of internal controls and the like. And as we know, and many CFOs are on the call, CFOs of public companies and private companies do not lack for challenges in today's environment. They have operational challenges to deal with evolving business models, such as their contracts, recurring revenue issues such as subscriptions and maintenance and renewals and things like that, and complex relationships with their customers and vendors. They have to deal with a lot of compliance issues, as we all know, with the advent of Sarbanes-Oxley and the implementation of Sarbanes-Oxley, and the ever-evolving issues regarding revenue recognition. And they also have to deal with a lot of financial reporting and visibility and transparency issues, and it makes for a much more complicated scenario. And our solutions, software solutions, closely align with these challenges of these companies to provide the following benefits in terms of helping to increase revenue and improve operational efficiencies, helping to manage really complex revenue transactions and forecasting, as well as related expense accounting issues to ensure compliance, and providing the strategic benefit of giving real insight into the business and the visibility of future performance to help executives make more strategic decisions. And our product line supports these three value propositions as well. We have billing and operations suites that deal with issues like contract management and complex billing and orders and contract renewals and subscription renewals and things like that. Very deep and unparalleled revenue recognition functionality and related expense functionality, and strategic products that help with visibility and strategic analysis of their business. And they are complemented by other products that you can see on the bottom of the screen. And we are pleased by hearing from customers in terms of value, and we drive a great deal of value in terms of improved compliance with Sarbanes-Oxley and revenue recognition issues, much more process efficiency, much higher process efficiency on the order of at least half in terms of areas of contract renewal and revenue forecasting and reporting and billing, and better relationships with their customers. So our mission is to help our customers increase their revenue, decrease their costs through a lot of operational efficiencies, all the while meeting the compliance needs that we see in today's environment. And lastly, certainly as it relates to the audit, as you would imagine, we spend a lot of time speaking with our customers about their audits and work to make sure that we provide solutions that can help them with automated financial documentation that they require, especially around the areas of revenue recognition. Help them provide a repeatable and audible process that helps them through the audit process. Could also help them in M&A activities and things like that, as people look very closely at such things as revenue. And help them as well in terms of making sure that their deferred revenue balances and the revenue streams moving forward offer them a lot of visibility, not only from an audit perspective, but from a strategic perspective as well. So let me take some time here and introduce our speakers. Just a few words about Grant Thornton. They were founded in 1924, and they're a leading global accounting, tax, and business advisory firm with 50 offices in the U.S. and almost 400 offices in 84 countries. Their business advisory services professionals help technology clients comply with requirements of Sarbanes-Oxley and issues with governance, risk management, and information technology process. And we are joined by two of their best, if I can say so, on the webcast today. Mike Schamberger is a partner with primary expertise in serving private and publicly held companies in advanced technologies such as telecommunications, software, hardware, internet, IT consulting, and biotech. He leads the technology industry practice in Chicago for Grant Thornton, and he is one of the 6 members of their national technology industry practice team. Welcome to Mike. And we also have Jim Ravell with us as well, and Mike will speak first, and Jim will speak after that. Jim is an insurance partner in the Minneapolis office, and he was just talking about the Twins over the White Sox, so they're at different locations today. Jim has his primary emphasis that relates to financial reporting and management, operational strategic issues, and planning. He has 27 years with the firm and has served a variety of public companies and private companies, primarily in technology, manufacturing, and distribution. And I'll turn this over to Jim in a minute. I'll remind those people who just joined that we'd love to have your questions. In order to do so, click on the question box and submit your questions, and I'll give those questions to both Mike and Jim at the end of our presentation and before the top of the hour. Welcome, Mike.
Okay, thank you, Bob, and good morning and good afternoon to everybody out there, depending on where you are in the country. I'm going to be talking about preparing for your audit and really kind of an insider's guide to preparing for the audit and really from the eyes of the auditor to the client. But first, even before I get in that area, what I want to talk about is really, what I want to begin to talk about is kind of the auditor prior state. This would be pre-SOX 404 versus what the current state is. Since SOX 404, and I know you private and non-accelerated filers out there are saying, well, I'm not really under SOX 404, but since SOX 404 has been passed, and not only that, because of the number of restatements that have taken place over the past few years. In fact, there was an article in the Wall Street Journal today that said that there were 1,200 restatements last year compared to only 270 restatements 5 years ago. And because of SOX 404 and because of the number of restatements that have taken place, really the whole auditing and accounting world has really been turned upside down. So kind of a prior state as it relates to internal controls, there have been some significant changes. Prior state in the audit work papers, they're kind of memos in the files describing significant internal control processes. So let me give you, for example, maybe for a $50 million company, a $100 million company, maybe a $20 million company. Obviously, if it's a lot larger, there may be a few more pages. But generally, it's a couple-page memo describing the payroll cycle and who's completing what, when, how, where, and why. The auditors would then go through maybe a couple transactions and walk through the whole system. Basically, what's required now is at the auditing firms, if you're a publicly held company or a privately held company, there's a full understanding of the internal controls. It's documented in the audit firm's software packages. It takes many hours in order to populate this particular software or the software packages that the accounting firms use. That software then is evaluated, and based upon auditor judgment, there's deficiencies, significant deficiencies, or perhaps material weaknesses that are discovered during the population and during the analysis of the internal control. Those deficiencies, significant deficiencies and material weaknesses need to be followed up by the auditor with management, and if they're material weaknesses, also have to be followed up with the audit committee and the board of directors. Obviously, for an accelerated filer, you have even more requirements from the audit perspective. There's the additional testing that's required of the auditors, and then if there's remediation of deficiencies that take place, that's also audited. From a technical pronouncement, prior state, there were some technical pronouncements out there, but if you read them a couple times, you could really understood what the FASB was saying, such as under FAS 109, 95, and also under FASB 87. But since SOX 404, what we call kind of hyper-technical issues, that's kind of the current state. FIN 48 just came out, which is going to be significant as it relates to taxes. FAS 123R, FAS 133, and even FIN 46. Whenever these types of issues arise during an audit or for a client, they are extremely complex, and generally what the audit team needs to do is speak with the technical people in order to make sure that the answer is correct and the accounting is proper, and obviously that adds hours to the audit and also expenses. Continuing on, materiality. I'm not going to specifically state what materiality is. It's different between firm to firm, but generally in the prior state it was a higher threshold for materiality, and now what we're seeing is that materiality threshold is being significantly lowered. In fact, the SEC just came out with new guidelines, SAB 108. This was issued on 9/13 a few days ago, basically requiring auditors to take a look at quantifying current year misstatements from both an iron curtain perspective and also from a rollover perspective. There's been significant increased scrutiny on auditors. The prior state was the auditors were always subject to internal and external peer review. However, in the current state, the internal and external peer review has become much more rigorous. And then not only that, with the advent of the PCAOB comes into the large accounting firms that practice before the SEC and also completes audits of them. In fact, last year I was, as an auditor, audited 3 times. And I know all you probably out there are kind of chuckling to yourself, great, it's good to see the auditors being audited. I was audited 3 times. Once from an internal peer review perspective, once from an external peer review perspective, and then also from a PCAOB review perspective. So it's much more rigorous. Other items in the current state is auditing firms, as many companies out there know, are limiting the consultant guidance as it relates to particular issues that arise. And not only that, but audit deadlines are moving earlier and earlier during the year. If you're an accelerated filer, you've obviously seen that over the past couple of years. If you're a non-accelerated filer, the financial statements are still due within 90 days after year-end, but that looks like it's going to be moving forward. And then also if you're a privately held entity, the investors and the bankers want to see the audits completed, the financial statements issued earlier than they have in the past. So hope this kind of gives you an idea as far as where the audit state is right now and why you're seeing significant increases in the audit fees that have taken place over the past couple of years. Preparing for the audit, this is kind of a nuts and bolts type of discussion here. It's really critical to meet with the auditors well in advance of the audit, and I don't mean just kind of a quick planning meeting, hour planning meeting, kind of a check the box meeting that's required of the auditors and client prior to the start of the field work, but really for the client to understand a number of items that I have listed here. First of all, new accounting standards and the audit impact. What new accounting standards have come out during the particular year or the year under audit? really for the client to understand what the audit impact is going to be. How many additional hours is it going to take to audit this particular new area? What are the additional fees that are going to be associated with it? Same thing with new auditing standards and the audit impact. Maybe a new auditing standard has not come out, but because of the peer reviews that have been taking place, the policies and methodologies with which the firms work with from an audit perspective have changed, and the client should really understand what the audit impact is going to be, if there's going to be additional testing that's required, and also what the additional fees are going to be associated with that. Clients should understand what the auditor critical cycles are. Compare those critical cycles with what the critical cycles were in past years. Why is there a reason, or why is there a change for the critical cycles? And then once again, the audit impact, how much additional time and how much additional fees. Same thing goes for the risk assessments. How is the auditor addressing the risk, or taking a look at the risk of the company? Has it changed from prior years? If it has, why? And then also the impact that it's going to have from an audit perspective. It's pretty critical for the client to understand the audit staff and their experience levels. If you have a new senior, a new staff, a couple new staff on the particular audit, obviously that's going to require more time from the client's perspective in order to answer questions that those particular auditors have. Timing of the field work and deliverables. That has a significant, you should understand when the audit field work is going to take place from an interim perspective, and really what's going to be completed during that interim phase. Can receivables and the revenue contracts and revenue cycle be audited at an interim date? What about fixed assets? If you have inventory, when is the observations going to take place, the valuation of that inventory? Intangibles can be audited. The goodwill can also be reviewed for impairment during an interim phase. And also, when is final field work? How long is it going to take final field work to be completed after the year end? And rolling forward those areas that were audited during the interim phase, and also taking a look at the debts and the payables and the cash and the area, those types of areas, and also completion of the financial statements. Fee structure. You need to gain a full understanding of the fee structure. It sounds pretty simple, but as you know, there's always additional fees that the auditors are looking for after the audit or during the audit. Understand the fee structure. What is the fee for the SOX 404 work going to be? Is it on a per hour basis, or is it a set amount? Same thing for the regular substantive piece of the audit. Or if you're not a non-accelerated filer or a private company, what's the fee structure going to be for the audit itself? What about additional costs that the auditors incur, or additional hours that the auditor incur? How is that going to be billed? What happens if the client has specific questions or technical questions that they need to ask of the auditor? Is that included in the audit fees, or are those additional fees that are billed at a later date? Communication with the management and the board. This is extremely important. Generally what I do for my audits is during field work, if it's an accelerated filer and we're completing and taking a look at the internal controls, and also for the non-accelerated filers and private companies out there during the interim and field work, we have weekly meetings, or I require weekly meetings with the audit team and then also with the client to make sure that I understand where the client stands in particular areas and getting information to us, and then also where the client wants to know specifically where we stand as auditors in completing the audit on a timely basis. Internal coordination of the audit. Once again, kind of nuts and bolts, meeting between the CFO and the accounting staff, or the controller and accounting staff, to determine timing. Basically, completing the year-end account reconciliations. When are those going to be completed? Also, an interim date. Who's going to do those particular reconciliations? Who it's going to be reviewed by? If you're a non-accelerated filer or a private company, you need to document the changes in the internal controls and make sure that the documentation of the internal controls are then forwarded to the auditors so they can include it within their software packages. If you're an accelerated filer, obviously there's a whole host of issues concerned with that. I could talk about probably about 2 hours just on that topic alone. And also delegate responsibilities for the preparation and timing of the required PBCs. These are schedules that the auditors require that those be completed at the outset of the audit in order to make the audit much more efficient. Here's some tips for an efficient and effective audit. First of all, have the auditors audit significant transactions and issues that arise during the year. For instance, if a company does an acquisition in the first quarter of the year, have the auditors take a look at that and have the auditors audit that particular transaction prior to year end. If there's options that are granted throughout the year, have the auditors audit the grants of those options throughout the year. It basically, it's much more efficient if the auditors can audit things before the year end, because once the year end comes in and once the final field work starts to kick in, time frames are very tight and time is at a premium. When issues arise during the audit, the client should really address those issues and take responsibility for those issues immediately, address the issues, and also present the conclusions of the company to the auditor and have discussions with the auditor to give them a heads up as far as where the company stands and what conclusions they reach. Keep the lines of communication open. Once again, kind of nuts and bolts, but keeping the lines of communication open through these weekly meetings or as additional issues arise and the auditor's not only giving the client a call, but also the client giving the auditors a call. There's less surprises during the audit, and it also makes it much more efficient and effective. As I said before, periodic meetings on a weekly basis. PBC schedules completed prior to the start of the audit. This is real critical and helps us in being most efficient and effective for the audit. I can't tell you how many times I've walked into a client and the client says, well, I'm done with 25% of the schedules you were requiring me to put together, and I'm going to be feeding you the rest of them as you go through the audit. Well, your employees have not only their regular jobs, but also they have to put together the remaining PBC schedules, which are going to be under a tight time frame. You have the auditors who are working anywhere from 60 to 80 hours are basically going to be completing the first tranche of those PBC schedules, the 25% that the client forwarded to them, fairly quickly in the audit process. And generally what happens is once those PBC schedules are completed by the auditors and nothing else is coming, then we're sitting around waiting for those schedules to be completed. So it is very critical that those be completed prior to the start of the audit. Financial statements, I know this is pretty nuts and bolts. Financial statements are responsibility of management, not the auditors. I can't tell you. I have a client of mine that's $100 million in revenue who still thinks that the audit and the financial statements are the responsibility of us. And every year I have to go in and coach the CFO and the CEO as far as for them to take responsibility for the financial statements and their books and records. And lastly, kind of a meeting between management and the audit team after the audit has been completed. Really kind of a post-mortem, discuss improvements that can be made for the audit from both the audit perspective and also from the client standpoint, talk about issues that arose during the audit, and also talk about the good things that took place to make sure that the following year's audit is much more efficient. That concludes my presentation. I'm going to hand it over to Jim Ravell, who will take it from here.
Jim, before you get started, Mike, if you could just answer a couple definition questions for people that came in. You mentioned iron curtain, if you could define that term, and another question is, what are PBC schedules on your last slide? So if you could have a few questions on those, and then we'll move on to Jim.
Okay. Iron curtain, basically, the SEC came out with, the SEC came out with SAB 108 on September 13th. And what this requires the auditor to do, and although I realize this is for public companies, it will be, I'm sure, adopted by all the accounting firms, whether you're a public company or private company. When you take a look at material misstatements or misstatements in the financial statements, some firms were looking at an iron curtain. In other words, what is the effect of on the P&L just for this year? Okay, they may have had this particular misstatement in years past, but really, what is only the current year effect of that misstatement for this year? The roll forward would be taking a look at the particular misstatement, but also in past years, those amounts relating to this particular issue. So, give you an example. Let's say there's an accrual that hasn't been recorded properly in the past 5 years, and each year it's $20,000, which is immaterial to financial statements. The iron curtain would say you'd only take a look at the $20,000 for this particular year. The rolling forward would say you'd have to take a look at the full $100,000 because of the additional $20,000 for each of the past 5 years. Generally, auditing firms would take a look at either the iron curtain rule or the roll forward rule. The SEC is saying you have to take a look at both those to make sure and to determine whether there's a misstatement to the financial statements. As it relates to PBCs, PBCs are what we call prepared by client schedules. So when the auditors come in and have a planning meeting with the client, generally what they'll do is they'll hand over a listing of schedules, documents, source documents that the auditors are going to need for the audit prior to the audit starting, hence prepared by clients, hence PBC schedules.
Great.
I hope that's clear.
No, that's clear now, and I just want to make sure that people understood that, didn't get too lost before we went to Jim. So,
Okay.
Thank you, Jim. Thank you, Mike, and on to Jim.
Very good. Thank you, and good day, everybody. I wanted to talk a little bit, building off of what Mike talked about, to talk about observations that we've seen where companies have tried to create some value from the audit process, and you know, tried to internalize some of the things that are either being thrust upon them from a public company standpoint or just changes in the industry over the past couple of years throughout their companies and industries. I make the comment on this slide that the audit is a gauge of the company's ability to produce external quality GAAP-based financial statements. And that's maybe a little different than how I may have phrased that statement a few years ago. You know, I think I spent a lot of years in this business where the audit was maybe a little bit more collaborative between management and the audit firm, and companies would close their books and you know, handle, you know, the day-to-day transactions real well in terms of how those affect their financial statements. And then during the audit process, there may have been some, you know, accruals or things that would be trued up, you know, once a year, and the audit firm would be involved with those decisions, and perhaps the audit firm would actually do certain things like an income tax accrual or something like that. And at the end of the day, you got to GAAP financial statements, and the true test of the audit was the auditor's opinion right, and were those financials, you know, fairly stated in accordance with GAAP. Well, we still do that piece. That's still the end objective of the audit, but now, you know, the audit is much more focused on the process from the company's standpoint to get to that stage of having GAAP-based financial statements. And I'm going to speak both from the perspective of dealing with public companies, both accelerated and non-accelerated filers, and private companies, because I deal with all three categories in my current practice. And I know there's probably some frustration from those of you who may work for private companies and see sort of the creep of accounting and auditing things that maybe were designed for public companies that get into the private company environment. So, you know, what we're seeing with a lot of companies that are really trying to internalize the audit process is they're trying to get to producing GAAP-based financial statements throughout their year or on a quarterly basis, something more than just at the end of the year. So what that means is they're identifying, you know, kind of the typical closing adjustments made, you know, monthly or quarterly, but they're also looking at the more unusual things, again, such as accruals or income taxes or whatever, and trying to true those up throughout the year and get those as solid as they can. They prepare ongoing analyses that they just keep rolling throughout the year, part of their normal books and records. So when the year-end audit does come around, they pretty much have their audit analyses done that they can hand off to the audit firm and say, you know, here's what we've done throughout the year, and it's a much more efficient way to go. You know, Mike mentioned having the audit firm audit transactions as they come up where there may be unusual accounting implications. And I think, you know, even before that happens, the company's accounting and finance staff, they have to identify what those accounting issues may be. And even before that, they have to be aware of the transactions. And I've worked with companies that, you know, sometimes the accounting department's kind of the last person to know that the company has entered into an unusual transaction, whether it be a revenue recognition issue or a financing, a stock-based issue, or even a compensation issue, where there's some pretty, you know, nasty accounting issues that, you know, the audit, or the company's internal accounting group, you know, didn't know about until the deal was done, and then everyone scrambles around to pick up the pieces. So internally, companies, I think, have done a much better job of working with, you know, their salespeople and other people within their companies to identify when unusual transactions are in the works, the accounting and finance group need to be in the loop on that so they can identify what unusual accounting implications may be. If companies do these things and are at a spot where they can produce GAAP-based financials throughout their year, it certainly makes the auditing function easier in terms of providing more flexibility. And the audit firm may choose to spread out the timing of the audit, do some things more on an interim basis, and just tries to alleviate some of the crunch that may happen at the traditional year-end audit fieldwork timing. The other important aspect of preparing accurate internal financial statements is in the planning process of the audit, where both the audit firm and management makes determinations as to scope of entities and materiality. From a 404 standpoint, for those public companies that have been dealing with the 404 work, they have to make determinations, as do the audit firms, as to which parts of their business or subsidiaries are within scope or not within scope, and then beyond that, which aspects of their financial statements are material. And it drives the 404 testing, it drives the financial auditing, and so both management and the audit firms do the same analysis there. Obviously, that analysis is easier if everyone's dealing with accurate financial statements that breaks down between all the various subsidiaries or divisions of a company in terms of what's where, and where's the inventory, and what are the cash balances look like, and where's the revenue throughout the company, particularly with international operations. As you're probably aware, if you do have international operations, it's an additional layer of coordination to get the audit firms internationally squared away with what needs to happen. And if that information is more accurate all the way around, that makes that process much easier. Part also of the value-added proposition is the various communications that happen during the process. And Mike referred to several of these in his comments. I think at the end of the audit, there needs to be pretty careful consideration internally by the company, and then with conversation with the audit firm about, how do we fix things that came up during the audit, whether they be remediation of internal control deficiencies, or where did audit adjustments happen, or even past adjustments, as Mike was just referring to the various methods of looking at the past adjustments. And then I think audit firms at least keep track of and may communicate to management whether there were omitted immaterial disclosures in the current financial statements that may be more material in the future. And so things to keep on a list for management to say, yeah, this was not material this year, but it may be material next year, and we should consider that. So trying to take the effort to keep all of these items at a minimum going forward. And I've seen a lot of discussion with audit committees in terms of looking at all these three areas and, challenging management, how are you going to deal with this? How do you get these lists of these differences down in the future? Mike mentioned some of the pre-audit discussions, which are very important. And to me, there's a couple of layers there. There's certainly the nuts and bolts of the audit in terms of timing and who's going to do what and what schedules need to be prepared and so forth. But hopefully companies and the audit firms take the time to have those discussions get a little bit broader, to talk about operational issues. It helps in the audit process, but I think it also just helps the understanding of both sides to understand where the companies are at and where they're going, and just an exchange of ideas on a more informal basis can go a long ways to set up future discussions on accounting issues that may arise. Certainly the discussions that audit firms have with the audit committee, board of directors, top management, particularly in a public company setting, but also I've had similar in private company settings. Very valuable part of the audit process, and something that I've seen really enhanced in the past couple of years after Sarbanes came in. It was sort of thrust upon audit committees, by legislation to have more robust meetings and responsibilities, and we saw boards of directors and audit committees take these responsibilities very seriously, and as time has gone on, develop into a very good pattern generally of communication and better understanding of what the companies do and what the financial reporting issues are. So that's been a very positive and value-added benefit of all this that's been going on in the past few years. Mike mentioned the postmortem, which I think is very valuable between management and the audit firm, just to loop back what went well, what didn't go well, how can we improve, and I've had a number of very good discussions with clients on that. And then certainly, as Mike also mentioned, the financial reporting and things that are coming down the pike, and just make sure that there's early identification of things that are looming, and both in terms of those communications at a management auditor level, as well as with the boards and the audit committee, so they can be aware of those. Strengthening the control environment. These are things that we've seen that companies have been concentrating on to enhance their internal control environment as a result of changes in the audit process over the past few years. In terms of their systems, we are seeing increased emphasis on automated or preventative controls. Most of our clients use fairly mainstream accounting and finance or ERP systems. There's a lot of built-in capacity and capabilities within those systems. A lot of that capacity sometimes our clients don't use. And so at a minimum, they tend to take a look, and we point them to, take a look at what your software can do that you already have, and maybe there's things that can be enhanced from a control standpoint. So again, having more things done from a control standpoint within the system, automated, and controls that are preventative, so you stem issues at the front end of a transaction versus trying to figure out later how you detect errors or problems later on. We've seen lots better documentation of policies and procedures within companies, which is a requirement for what we look at as we do internal control work, but it certainly is a value add for companies to help them as they train new people that may come into their organizations. Naturally with turnover, have better job descriptions, accounting processes in place, and just makes it a lot smoother in terms of laid out on paper who does what and what are our policies there, rather than it's kind of within certain people's heads in terms of what they do. And companies are doing a better job of documenting the control procedures that they do. Again, this is driven out of requirement, but it's also helped companies internally understand who is looking at certain documents, who's signing off, who's approving certain transactions. Companies are bringing more capabilities in-house. And, we deal at Grant Thornton with primarily middle market companies. And so, those of you who maybe work in or be more familiar with a larger company, a Fortune 500 type company, there are functions that have been in place in the larger companies for years, such as directors of financial reporting, internal control, obviously internal audit, tax directors, things like that. Those are things that we are seeing more and more in middle market companies, both publicly held and privately held. And just beefing up the capabilities that were currently or previously outsourced either to the CPA audit firm or to other organizations. We're seeing we do some work for larger organizations on a selected services basis, and we are seeing in some of the large organizations the internal control function maybe raising up to a higher level, more directorship type titles for the people that run those pieces of the business, we're actually seeing compensation and bonuses being driven based on aspects of internal control, performance, and findings. So much higher elevation of that whole area with the bigger companies. But again, in the mid-sized companies, we're seeing a lot of those capabilities being brought in-house. We're also seeing a lot more work on the technical accounting issue side in-house. Again, if you're bringing in people that are skilled in external financial reporting, they're the ones that are doing the first cut at research and getting sign-offs within the company before that's shared with the audit firms. One client that we have here in our office has a nice system where they have their technical memos that they generate internally, all signed off by management and in a book every year that's given to the audit firm throughout the year, and it's well documented. Companies are doing a good job, in my view, of addressing control deficiencies or determining that they will not correct them for a cost-benefit reason. And that's fine, too, as long as everyone's aware that that's the proper way to go, and there's good discussion about that both with management and with a board or audit committee. And as I mentioned, we're seeing very good communications typically with audit committees, and I think overall just better tone at the top, enhanced governance, and just meaningful discussions with top management and boards of directors across the board. People are understanding the importance of the audit function and really are taking that effort very seriously. Looking forward just a little bit in terms of, where specifically related to internal controls, where are we seeing some things go? We're continuing to see in the profession for both public companies and private companies, emphasis on an efficient, integrated approach. And integrated, I mean integrated between the internal control work that is done and the financial audit work that's done. So those two will continue to go hand in hand. Firms are typically looking at a top-down, risk-based approach, focusing on the areas of high fraud risk and material misstatement, trying to be much more selective about things that will be done, and gets back to the good planning and good identification of those risk areas. So from a control standpoint, I think the auditors may zero in on a specific area, and the controls need to address those specific risks that the company has. It's all on a risk-based system. Auditors are getting a little bit more leeway and guidance on how they can rely on the work of others, particularly in the 404 testing. They can rely more on prior experience that they've had with the client companies. And there's continuing dialogue and guidance out there in terms of how to evaluate deficiencies in the control structure and how are those classified, whether they be a control deficiency or a significant deficiency or even a material weakness. There's a fair amount of art to that process. It's not a science in all cases, and so there needs to be, and there has been, additional guidance coming out on making those kind of determinations. One important area that we've seen is in the remediation of control deficiencies during the audit process, towards the end of the audit process. And this has been an area that has been entails a lot of discussion between the audit firm and the clients, and a fair amount of frustration in terms of, I think part of it is everyone needs to learn sort of the same vocabulary and understanding of what controls are or what they may not be, and what types of controls are we talking about. There's different guidance out there in terms of what different types of deficiencies can be remediated during an audit period or cannot be, depending on when the issue arose. So I think everyone needs to take a step back and understand what type of control are we talking about? Is that a pervasive or non-pervasive control? Is it at an entity level, or is it at a lower activity level, transactional level? Is it an IT control? In what process did it happen, and how important is that process? And what was the frequency of the issue, and was the control automated or manual? All these things go into the mix in terms of how do you remediate this? Can it be remediated successfully and retested during an audit period? So I try to encourage both the audit teams and the companies to make sure we're all clear in terms of what kind of controls we're talking about, and so at least we can have a discussion using, again, the same language and vocabulary. Again, there is guidance out there in terms of how controls can be remediated or not, and what the timing is to do that. And I think the companies need to inquire about their audit firms in terms of what policies the audit firms have in terms of what they will accept or not accept in terms of time frames and practices to remediate controls. I think the larger firms are pretty consistent in that, but it's still a discussion that should be had along the way, probably early on in the planning phase of the audit, to make sure everyone's clear if and when control issues come up, how will they be handled by both sides. I believe with that, we are ready to go to questions.
Thanks, Jim. We have one right on that topic, and so I'll start. There are lots of questions, and I would continue people to submit them by clicking the Ask a Question box and submitting them, and I'll continue to look at these. But just while you still have that fresh in your mind, someone asked as you were speaking, where could they find the new official guidance for determining deficiencies? Where would they go?
Well, and Mike, you might want to help me on this one too. I mean, it was has been in AS2.
Yes.
Which is the accounting standards number 2 that came out from the PCAOB. That's, I believe, the most recent source of where that is. But there is ongoing discussion at this point. I don't think it's been codified or finalized yet in terms of maybe there'll be some additional guidance on what makes up a significant deficiency versus a material weakness.
Okay. We must have some audit committee members or some people want to talk about that, so we had lots of questions about that. So let me put a few out there, and both of you touched on some of these. Mike, you mentioned about better communications with the board, and Jim, you did as well. Can you be more specific on what's expected of the audit committee with respect to the relationship with the auditor? That would be the first part of the question, and I'll just put them all out here for you to answer. The second was from a chair of a committee from some public companies who sometimes has trouble convincing management and the auditors that the audit committee actually appoints the auditor, and sometimes finds signed engagement letters by management. What to do about that situation? Any consequences? Any guidance and opinion on that? So can you be more specific about the relationship, and then the more specific question to follow?
Yeah, from the communications perspective, generally what we'll do is we'll communicate a number of times with the audit committee, anywhere from 6 to 8 times during the year. Starting off with, let's say for a year, each quarter, just before the financial statements are going to either A, be released to the public, or B, filed with the SEC and released to the public. There's generally a discussion with the audit committee with management, the auditors, and the audit committee, going through what the results and findings were of the auditors for the quarter. And then also there's a executive session between the auditors and only the audit committee, with the audit committee asking questions such as, how did they perform? Do they have the right people in the right places? Things of that nature. Outside of the quarterly communications, prior to the audit starting, what we'll do is we'll have a meeting with the management and also the audit committee and kind of present a scope of audit services. What are critical areas? What are we going to be doing? What's the timing? Who's going to be on the account? Who the partner is? Who the tax partner is? Who the managers are? Timing of particular deliverables, such as the independence letter, such as the audit report itself and the consents, and when the 10K is going to be filed, things of that nature. Then there's usually a couple more conversations with the audit committee, usually towards the end of the audit, one just before the release of the earnings, once again just to kind of go through the audit, what the results were, and then once just before the filing of the 10K, and once again what the results of the audit were. In both occasions, there is also a executive session between the auditors and the audit committee, and once again with the audit committee wanting to know how the audit went, how was management, were they able to address all of the issues that arose on a timely basis, things of that nature. As it relates to the appointment of auditors, the audit committee is correct. The audit committee is to appoint the auditors. It is not management, and the engagement letter is to be addressed to, at least in our perspective, the engagement letter is addressed to the audit committee, the chair of the audit committee. The chairman of the audit committee has to sign off and sign the engagement letter along with upper management. So why the engagement letter is not going to the audit committee chair or the audit committee members prior to being signed by the management, that I don't know why that particular audit committee member, audit committee chairman needs to talk directly with the partner on the account.
Okay. Great. Well, let's move on then. You both talked, Mike and Jim, about materiality, and you said, Mike, that it goes kind of from firm to firm and so forth, and the SAB 108 in September. Can you give any guidance on at least a process? You know, how would one go about getting their hands around materiality for their company?
Well, Jim, I'll add a couple comments. You know, I think the SEC has been fairly consistent in their view of, you know, for a lot of companies, they look at pre-tax earnings as sort of a key number and build off materiality off of that. You know, and you know, there's numbers thrown around, whether that be, you know, 5% of that number, 10% of that number, you know, somewhere in that range. I think a lot of firms look at factors beyond that. They look at other financial drivers of the company, whether it be revenue or assets or earnings, things of that nature, and as a process go through various levels of assessing percentages off of all of those areas and coming to what's the best measure of the company's financial performance and how should we base our judgments off of it. So yeah, at least the firms that I'm familiar with, it's sort of a multi-tiered approach in terms of what's the appropriate financial measure to use and then what's the appropriate percentages to use.
Yeah, another key area in connection with materiality is when calculating the loan covenants. If a company is just within formula, even a small adjustment, $10,000, $20,000, may push the company out of formula on a particular loan covenant, which would be material to the financial statement. So it's not necessarily just a percentage. It also could relate to a dollar amount, and like Jim said, it's looked at in various ways.
Okay, Mike, you touched on consultative guidelines, where auditors now have to have limited their consultation. I think we all have seen the changes in that. Can you help our audience get their arms around how they might, again, understand what they can use their auditor for in terms of consultation, or do they just push the auditor to the limit until they say no? So how does that work in terms of that relationship and defining the new rules in terms of consultation? And we see a lot, certainly, from our customers in revenue recognition and large contracts and things like that. So any advice for our audience?
Yeah, generally, since, you know, SOX 404 and the advent of the PCAOB, what a lot of firms did was they kind of took a hard stance that they can't be consultative in nature with their audit clients, where if a particular issue arose and the firm or the company was not able to handle the transaction internally, they would have to go externally to get that resolved. And they really weren't able to or weren't able to use the auditors for guidance and to help them in resolving the issue. Firms have started to back down from that. The SEC and also the PCAOB have said, hey, look, auditors, you can be consultative in nature. You just can't tell them specifically how to book a particular entry. We here at Grant Thornton have always been somewhat consultative in nature, even with the advent of the PCAOB. If a client has a particular issue, we would like them to do as much research as they can to get their arms around the particular issue, do the research internally, and then perhaps come to us with the particular issue. And if they need help in trying to determine how to account for it, we'll be consultative in nature and give different views on the particular issue if there are different views, and kind of help them come to a conclusion to determine what their proper accounting is.
All right, Jim, you mentioned the term tone at the top, which we hear quite a bit. And is there any way to measure that? A few questions about that.
Yeah, that's one of those squishy ones that is difficult to measure. But I think it does play itself out in terms of what kind of issues or lack of issues are coming through the audit process, or just the normal financial reporting process of a company. If top management is singing the correct tone at the top, I think everyone is motivated to drive excellence throughout the organization, including the financial side of things, and you just see less issues, and you see better cooperation both within the company and with the audit firm and others to just get as best a product as you can.
Okay. Still squishy, maybe.
Very.
Yes, very.
Question about remediation documentation. What type of documentation is needed to support the cost-benefit analysis of remediation?
Well, again, that deals with, what kind of control are you talking about, and how pervasive is it, and what kind of transaction is it, and so forth. So it's really, there's a couple pieces to that. One is making sure everyone's clear as to what kind of control it is and what the effects of the control or lack thereof may be on the financial statements. And then there can be some pretty prescriptive guidance out there in terms of, you got to demonstrate that this control is in effect for a certain period of time before the auditors can sign off on it. So it really does vary. If it's a quarterly control or a monthly control, it's a different answer than if it's a transactional-based control.
Okay. Another question here in terms of forward-looking for people this year's audit. Besides stock options, and you may want to comment on stock options as well, but the question is, besides stock options, what other areas of concentration do you expect in this year's integrated audit?
Well, I think, on integrated audits for public companies, we continue to focus on the risk-based approach that I spoke of, and trying to be a little bit more smart in terms of what areas we're focused on, and focusing our testing on that. In terms of accounting issues, the one that Mike mentioned early on was the FIN 48, which is kind of a nasty one dealing with uncertain tax positions. And that's going to be a problem child, not so much for the December 3106 audits, but starting in 07, that people are going to have to spend some time with.
Yeah, and in connection with FIN 48, even though it is an 07 issue, for the public companies, it's really a first quarter 07 issue. So it's something that they really need to start looking at now, as opposed to waiting until first quarter to start the analysis. And obviously, for the privately held companies, they do have a year with which to implement it, but it is a fairly pervasive, and it's going to require a lot of time, effort, and energy in order to get it right, accounting pronouncement.
This is the first time that we have done a webcast with auditors and not gotten a question about fees. And I don't know whether it's like gasoline prices, people just got used to them, although gas prices are coming down, and I'm not so sure the auditors' fees will. So I'm not going to ask the question because our audience did not, but unless either of you want to talk about fees?
Yeah, from a fees perspective, generally what we're seeing is as we're going into what the third year of SOX 404 here, that you're starting to see at least that piece of the audit fee decline as we become more proficient in internal controls and documentation and testing and remediation efforts and determining what's a critical cycle and what's not a critical cycle. You should be seeing those as long as the business has been static. From a operations perspective, you see those fees starting to decline. Obviously, if the company enters into an acquisition or the internal controls significantly change, then obviously those fees will go up. But as it relates to the substantive piece, if you're a privately held company or a non-accelerated filer, you're seeing still upward pressure on audit fees as a result of the additional policies and procedures that we're required to do as auditors and because of the accounting pronouncements that are coming out.
Well, then our record is still intact of always talking about fees. So thank you very much. We appreciate your time, both Mike and Jim from Grant Thornton. Thank you to the audience for your participation, your questions. I'm sorry we couldn't get to them all. I want to remind people, and we still have questions coming in now about how to get copies of the slides. Very soon your screen will go to a browser. What you need to do at that point is click on that and just fill out quickly the online survey page, which we listen to very closely. That will allow you to get the presentation slides as well as the bonus survey report from Grant Thornton. And again, thank you very much, Mike and Jim, and thank you to Grant Thornton, and thank you to the audience.